Today, I want to share about August outlook for the S&P 500 and broader market. Now, the stock market summer rally faces a major test as we head into August, right? July has been another solid month with the S&P 500 gain roughly 3.49% and the tech-heavy Nasdaq about 3.9%, extending a strong rebound since the spring slump. Now, in fact, the S&P 500 has now risen 4 months in a row, April through July. Now, the question is whether this momentum can continue into August to notch a fifth consecutive monthly gain, or if the market seasonal weakness and other headwinds will finally cool the rally. So, first of all, is we need to know the historical August performance. Now, according to the Stock Traders Almanac, right, August has historically been one of the weakest months for equities, especially in the post-election years like 2025. Now, Jeff Hirsch, Almanac's editor, note that August is the worst month in the post-election years for the Dow Jones Industrial Average DJIA and Russell 1000, and the second worst for the S&P 500, Nasdaq, and Russell 2000. On average, major index have posted negative returns in August, with post-election years August seeing declines in the 0.5% to 1.5% range. Now, the table below here shows the average August performance for key indices and their rank among the 12 months, 1 being the best and 12 being the worst, based on decades of almanac data since 1950 for Dow and S&P, 1971 for Nasdaq, and the 1979 for the Russell indices. And if you can see from here, all are negative on average, making August among the worst months of the year for stock performances. Now, not only are the average returns lackluster, but more Augusts have been down than up for these indexes historically. The seasonal tailwind that often buoys stocks early in the year tends to fade in late summer, a pattern traders are wary of. Given this context, investors shouldn't be surprised if the market's recent strength moderates in August, okay? Now, how do you know overall, is the market doing okay or not okay? Is it doing well? We need to look at the earnings, and we need to look at the earnings the quarter before. Now we are in quarter 3, right? So we need to look at earnings in quarter 2 2025. Now we are in the middle of Q2 2025 earnings season, and many top companies have reported results. These reports give insight into whether corporate profits are improving or deteriorating, which in turn affects stocks valuation and sentiment. Now, the S&P 500 earnings have been growing year over year for 8 consecutive quarters, but the pace of growth has been uneven. Here's a comparison of recent quarters. Now, Q3 2024 earnings grew only about 5.8% year on year, a relative modest increase. Now, quarter 4 2024 earnings growth surged to 16 to 17%, the fastest pace in 3 years. This jump was partly due to easy comparisons for quarter 4 2023 because it had weak earnings, especially in sectors like banking. In fact, quarter 4 2024 marked the highest year-on-year earnings growth for the index since 2021. Now, for quarter 1 2025, growth cooled to roughly 7% year-on-year as the boost from those one-time factors faded. Still, this was the 7th straight quarter of earnings improvement. Now we are at quarter 2 2025. Early results suggest about 6% earnings growth year-on-year, the slowest growth rate since quarter 1 2024. Okay, so in other words, profit growth have decelerated back to mid-single-digit pace after the big Q4 spike. Now, approximately 1/3 of S&P 500 companies had reported by late July, and while around 80% beat their earnings per share estimates, which is above the 5-year average, the margin of beats about 6% above forecast is smaller than usual. Now, this indicates that although companies are clearing the bar set by analysts, they aren't delivering huge upside surprises on earnings. Now, in summary, while aggregates S&P 500 earnings growth still appear moderate between 5 to 6%, influenced by weaker performances elsewhere, the Q2 beat profile from mega caps is strong enough to offset some softness that we have seen so far. Now, this mixed earnings picture could make it harder for stocks to keep climbing without other catalysts, and this is what we are waiting for. If it doesn't come, yeah, it is what it is already. So the next part we have seen how the earnings are. The next, I think the important thing is to actually know the valuations. Okay. Now, strong equity returns in recent months have pushed valuations higher even as earnings grow only moderately. As of the end of July 2025, the S&P's forward 12-month PE is about 22.4. This is well above the historical norms. For context, the 5-year PE is 19.9 and the 10-year average is 18.4. Now, in fact, valuations are back to where they were in early February of this year, just before a tariff scare sparked a spring sell-off. Now, in short, stocks are not cheap at current levels, as they are priced quite optimistically relative to expected earnings. Now, high valuations don't guarantee a pullback, but they do imply that a lot of good news is already priced in. So if earnings or economic data disappoint, an expensive market can be vulnerable to a decline. On the flip side, continued positive surprises could justify these valuations, but there is less margin for error now. Okay? So what are the tailwinds and headwinds for the month of August? Now, why do I want to talk about this? Because there are many things we need to look at. Because, even though like I give you a very, very good example, just one single word, tariff, that alone, it hasn't settled yet. So that could create headwinds. But at the same time, that also could create tailwinds, right? So now what we want to look is that, we need to consider both these tailwinds and headwinds, and on balance, they suggest that supportive breeze pushing stocks may ease up in August. Why do I say that? Now, as discussed, seasonality is turning unfavorable. The usual summer tailwinds wane in August, historically a weak month. This doesn't guarantee a drop, but the lack of positive seasonal bias means the market may not get its usual summer drift higher. Now, the tailwind from earnings growth is moderate at best. There isn't a strong acceleration in earnings to fuel a further market melt-up. More sectors are seeing earnings declines than gains in Q2, 6 sectors down versus 5 up, with energy companies in particular dragging down their aggregates. The market will be monitoring if earnings forecasts for the rest of 2025 hold up, as any wave of negative guidance could be a headwind. Now, the economic backdrop is a mixed bag at the moment. Inflation has been cooling. The CPI was 2.7% in June, down from 3% at the end of 2024, and remains above the Fed's 2% target, but is moving in the right direction. Labor market is showing signs of weakening with unemployment at 4.2%. Now, labor market, we had a real shocker, due to the revision that caused Donald Trump to fire the person in charge of this labor market measuring, right? So, we know that, non-farm payrolls, the numbers are always massaged, but not to this point where we are talking a 200 plus K difference, right? So many investors expect the Fed to start cutting interest rates later in the year, possibly September, to support the economy. However, if upcoming data in August on jobs or inflations, etc., show the economy humming along with only sticky inflation, the Fed may hold off on rate cuts. Now, the absence of a Fed rate cut or even hints of delaying easing could remove a potential tailwind for stocks. On the other hand, if we see any economic softening, Okay, so we are seeing some right now, but is that going to continue? Because that unemployment thing is a problem, right? Or a sharp drop in inflation. If we see that, markets may anticipate Fed easing sooner, which could be a positive tailwind. Okay, so right now, right, August the 1st marks a deadline in trade negotiations. Only trade discussions with China, Canada, and Mexico is still ongoing. That need to be settled, and that's very, very important for the US economy. So if trade deals with the 3 fall short of expectations, there's a risk that tariffs could be reinstated or expanded. That could introduce a headwind by raising costs, potentially rekindling inflation and hurting corporate supply chains. Conversely, any positive resolution on trade would remove a cloud of uncertainty. So, after a surge of 28% in the S&P over the past few months, sentiment indicators have turned fairly bullish right now, and some might say frothy. Investor surveys and momentum measures show optimism is high. While confidence can sustain rally, it also means vulnerability. Okay, so be careful, because if something goes wrong, there may be fewer bargain hunters left to buy the dips. Since so many are already fully invested, additionally, August and September are known for bouts of volatility. Low trading volumes and vacation seasons can exacerbate market swings. Any shock of even normal profit taking could lead to a pullback simply due to how extended the market runs have been. Okay, so with that, that's how we are looking at the August month, and let's see whether it plays according to the tune or not that we have always been looking at. Okay, so with that, that's the report for today. Let's move on to the charts.